You can draw a perfect zone and still lose if you're trading it against the bigger picture. The fix is to work top-down. Let the higher time frame tell you which direction to trade and which zones even matter, then drop to a lower time frame for a precise entry. This one habit filters out a huge chunk of losing trades. Let's walk through it. Start on a higher time frame, say the 4-hour or the daily. Your only job there is to answer one question. Which way is price trending? If it's an uptrend, you only look to buy from demand zones. If it's a downtrend, you only look to sell from supply zones. Zones that would have you trading against that trend, you simply ignore. The higher time frame is the boss. It sets your bias before you even think about an entry. The higher time frame does a second job too. It shows you where to act. Mark the major demand and supply zones up there, and those become your target areas, the places worth caring about. You're not hunting for setups all over the chart. You're waiting for price to travel to one of those higher time frame zones. Direction from the trend, location from the zone. Now you know both what you're looking for and where. Here's where it gets powerful. When price reaches your higher time frame zone, zoom in. Drop to a lower time frame, like the 15 or 5-minute. Inside that big zone, you'll usually find a smaller, fresh zone that lines up with it, a nested zone. Enter from that instead. Same trade, but your stop is a fraction of the size, which means a much bigger reward to risk. The higher time frame found the trade. The lower time frame sharpened it. Prop challenge, or leveling up your own trading. Signal Deck tracks every trade in R with quant-level analytics. Prove your edge. Free. Link in the description. Let's stack the layers. The higher time frame trend gives you direction by demand or sell supply. The higher time frame zone gives you the where, the area to wait for. The lower time frame zone gives you the precise entry and a tight stop. 3 layers, each answering a different question, all pointing the same way. When they agree, you've got a real setup. When they conflict, you pass. That agreement is the whole point of top-down analysis. Recap. Read direction from the higher time frame trend, read location from the higher time frame zones, and only take trades that agree with both, buying demand and uptrends, selling supply and downtrends. Then drop down for a tight, nested entry. Next episode, we get specific about pulling the trigger, how to enter a zone, when to wait for confirmation, and exactly where the stop goes. Subscribe and I'll see you there.